98 cents per share. That is where the AMC Theatres, the world's largest movie theater chain, stock was sitting as of March 20th, 2026. Now, for a company that was at over $600 per share just a couple of years ago, this isn't just a number, it's a full-blown crisis. Now, in the last 5 years, AMC Theatres, the largest movie theater chain in not only America but the entire world, has gone from a pandemic survivor to a meme stock legend, and now to a company staring down the barrel of a possible New York Stock Exchange delisting. But how did we get here? How did a company that was the talk of Wall Street lose over 99% of its value from its 2021 peak? And what dangers and fallout does the company face if things don't turn around fast? Now, before we dive in full detail, here's the overall roadmap for this video. We're going to cover each point with full explanations in the video, so here's the outline. In 2020 to 2021, AMC was in danger of bankruptcy due to massive spending just before the pandemic hit. Then, the meme stock phenomenon hit, artificially skyrocketing AMC's split-adjusted stock price up to around $700 a share. Then we'll talk about how AMC took advantage of the meme stock, selling new shares to raise massive amounts of money to keep operating. We're going to talk about how creating and selling new shares diluted the existing shares, and how the shares have continued to drop in value to just 98 cents per share as of March 2026. We're going to discuss how falling under $1 a share runs the risk of AMC stock getting delisted from the New York Stock Exchange. Then we're going to talk about what getting delisted would mean and how it puts them in danger of bankruptcy and how bankruptcy would wipe out everybody's shares. Then we're going to end off with how AMC can avoid and survive this crisis. Now, if we're going to understand this crash, we first have to understand the before times. See, before 2020, AMC wasn't exactly a tech growth darling. They were a massive debt-heavy company that had spent billions of dollars acquiring other movie theater chains like Carmike and Odeon, and on much-needed theater improvements. They needed to do that. But by 2019, they were already struggling with a $5 billion debt load. And then the 2020 pandemic happened at the worst possible time for AMC. The world shut down. Theaters went dark for months. For a company that relies on selling $15 popcorn buckets and $10 soda just to pay off billions in loans, this was an extinction-level event. By late 2020, bankruptcy for AMC wasn't just a possibility, it was the consensus. But then, nothing short of a miracle happened. In early 2021, fueled by the same meme energy that sent GameStop to the stratosphere, rebel investors flooded into AMC. The AMC stock skyrocketed to an all-time high, at one point hitting a split-adjusted price of around $700 a share. So AMC CEO Adam Aron saw an opportunity in this blind dumb luck. He used the meme stock hype to sell new shares at their artificially inflated prices, raising billions of dollars in cash to keep the lights on and the company from going bankrupt. It was an opportunity that kept AMC in business. However, this maneuver came at a cost. Stock dilution. You see, to keep the company alive, AMC had to print more and more shares to sell, which meant each individual share owned by an investor represented a smaller and smaller piece of the pie. The more shares they make and sell, the less the shares you own are actually worth. Think of it like this. Let's say you own 100 shares of a fictional company called Filthy Inc., and in total there are 1,000 shares of the company. Your 100 shares represents 10% of the company. Now, let's say the company itself is worth $1,000. Great. Your shares represent 10% of the company. So your shares are worth $100, which is 10% of the $1,000 valuation. Got it? Great. But now what happens if Filthy Inc. creates and sells 1,000 more shares to other investors to help pay the bills? Well, now there are 2,000 shares in total, and your 100 shares now only represent 5% of the total shares instead of 10%. The company is still only worth $1,000, so your shares are now only worth $50, which is 5% of the total value. So the more shares AMC create and sold to raise money, the less and less each share became worth. Which brings us to the $1 problem and delisting. So here we are. The AMC stock is now in the $1 per share range, actually a little bit lower. So why is this specific number such a nightmare? Well, the New York Stock Exchange has what's called a minimum bid price rule. If a stock's average closing price stays below $1 for 30 consecutive trading days, the New York Stock Exchange issues the dreaded deficiency notice. A deficiency notice from the New York Stock Exchange is a formal warning issued to a publicly traded company indicating that it no longer meets one or more of the exchange's required listing standards, such as minimum share price. Once that deficiency notice hits, the clock starts. AMC would have 6 months to cure the price. To get back in the clear, the stock needs to hit at least $1 on the last day of a month and have an average price of $1 or higher for the preceding 30 days. And if they fail, they get delisted. Now, you might be saying to yourselves, well, okay, that doesn't sound so good, but is it really that big of a deal? Fair question, so let's take a look at this. The consequences of delisting. If your company gets delisted off the New York Stock Exchange, several very negative things can happen, starting with institutional exodus. Many pension funds and mutual funds are legally barred from owning stocks that aren't on a major stock exchange. They would be forced to sell their shares. And in the stock market, when a stock starts selling off its shares, the price drops even more. It then becomes a liquidity trap. It becomes harder to buy and sell shares of your stock because several brokerages and major trading platforms like Robinhood and Webull do not permit trading on OTCs. Another problem is capital access. This is the most critical point for AMC specifically. For the last few years, like I mentioned earlier, CEO Adam Aron has kept AMC afloat by selling new shares of the stock. This cash is what they use to pay their bills and keep the lights on. But this becomes exponentially more difficult to continue if they aren't on a major stock exchange. And even if they could, at this point, the dilution becomes a death spiral. If the stock price is at 50 cents, AMC would have to issue a staggering number of shares to raise even a small amount of cash. This hyperdilution makes the stock practically worthless to investors, effectively cutting off AMC's only way to get new money. So think of it like this. If AMC needed to raise $100 and their stock was worth $10, then they'd only need to sell 10 new shares to raise that $100. But if the shares are only worth 25 cents, they have to sell 400 new shares to raise that same $100. And that drastically dilutes the existing shares value even more, and the wheel keeps spinning. Now, ultimately, if left unchecked, this dilution death spiral, if not addressed and corrected, can lead to AMC going into Chapter 11, also known as bankruptcy. Delisting is frequently the final stage before Chapter 11 filing. So, let's now take a look at what would push AMC into bankruptcy and what happens if they do. First of all, if AMC Theatres gets delisted from the stock exchange, it would trigger a default in what's called the debt covenants. So what are debt covenants? Many of AMC's corporate loan agreements, their debt, include clauses called maintenance of listing covenants. These clauses state that if the company is delisted from the New York Stock Exchange, it is considered in technical default. Now, once a technical default occurs, AMC's lenders, the banks and other organizations who AMC owes money to, those lenders have the right to demand the entire multi-billion-dollar balance be paid back immediately, which AMC obviously can't do, because AMC currently only has about $428 million in cash as of early 2026, but billions in total debt. If the lenders demand payment and AMC can't sell stock to raise the cash because they are delisted, they have no choice but to file for Chapter 11 bankruptcy. So in a bankruptcy scenario, the company might survive, but the stock usually does not survive. So what happens? Well, the first option is restructuring. A court oversees a plan where AMC's lenders, who are owed billions of dollars, become the new owners of AMC. But the problem for the shareholders is the stock wipeout. In almost every bankruptcy case, existing common stockholders, the shares you buy on Robinhood or E-Trade, is canceled and becomes worth zero. Sorry, your shares are now worthless. So is it over? Is AMC now completely screwed? Well, not necessarily. AMC has a few break glass in case of emergency options still available to them that very well may see them come out of this okay. For example, they could do another reverse stock split. They could do a 1-to-10 split again. So if you own 10 shares worth $1 each, your shares would be combined into one single share that is still worth $10. Abracadabra, AMC shares are now worth $10 again. Now, this would get them another year or two of compliance in time, but shareholders hate this as it usually leads to more selling and even more dilution, which is what's killing them in the first place. They can also do debt restructuring. Now, AMC right now is already working with lenders to push back the payment of their debts further, buying them even more time. Now, if they can convince their lenders that they are still a viable business, they could survive this. Another thing that could save them is a box office turnaround. See, they need a string of big hits, multi-billion-dollar hits, to prove that the theater business is actually back to 2019 levels. Now, if they can, optimism in the company could see share prices rise higher on their own without having to do a reverse stock split, thus avoiding the delisting from the stock exchange and solving most of their problems. The good news for AMC is that 2026 is an extremely strong-looking year for big box office films that could significantly turn their fortunes around. Movies like Mario Brothers, Toy Story, Hunger Games, The Odyssey, Dune 3, Spider-Man, Avengers, Doomsday, and many others. Well, these films could end up saving AMC. At the end of the day, AMC has survived certain death several times in the last 5 years, so don't count them out just yet, because there are several avenues they have to weather this storm. But at under $1 a share, they just don't have as many avenues to salvation as they used to. What do you guys think? Are you still holding, or is the $1 mark the final curtain call for this cinema giant? Let me know down in the comments below. Thanks a lot for joining me, guys. I hope you found this video at least a little bit helpful. My name is John Campea, and until next time, my friends, bye-bye.